Hi, welcome to Ventura. In the next few minutes, we are going to tell you what a short straddle is and when you should try to employ it. Then we'll tell you what exactly it entails, what you can expect to gain or lose if the stock moves as per or against your expectations, and finally we'll run you through a practical numerical example to illustrate the concept, followed by a review of the concept. A short straddle entails going short or selling options. It involves selling a call option and a put option, both at the same strike price. So effectively it results in straddling that strike price. Now when should you employ a short straddle? The most essential condition for this strategy to deliver gains is that the market must be range bound. That is more or less neutral. It is ideal for a market in which volatility is low and stocks and indices are not moving much. Here's what you need to do to undertake a short straddle. You sell a call option on a particular stock or index and simultaneously you sell a put option at the same strike price. Now why would someone go for a short straddle? Firstly, your incentive to undertake a short straddle is the credit that you earn from both the call and the put that you sell in the form of premiums. Secondly, since you expect the underlying to remain relatively steady, you expect that you will get to retain most of the premium income. Finally, you are aware that in case the market does not move substantially, you could lose more than the premiums that you earn. In fact, your loss will depend totally on the extent to which the market moves. In a short straddle, your returns are limited to the premiums that you receive. Your risk, however, is unlimited. It is determined by the extent to which the price of the underlying is different from the strike price that you've sold the options. The further away the maturity price from the strike price, either above or below, the greater will be your loss. Here's an example to make the strategy really clear. Let's suppose the Nifty current month futures at 6,000 and you feel it will remain at that level on maturity. You could set up a short straddle by selling one lot of a 6,000 call option and simultaneously selling one lot of the 6,000 put option. This strategy will earn you Rs 200 in the form of premium credit. And this is what your payoff graph will look like. If at maturity the price remains at 6,000, you make a profit of Rs 200, which is the net premium as both your options expire worthless. If, however, the price rises above 6,200 or falls below 5,800, you start making a loss. Anything within the range of 5,800 and 6,200 will give you some return below Rs 200. As you can see from the payoff table, your break-even point is at 5,800 and 6,200. Once the Nifty goes below 5,800 or above 6,200, you start making a loss. If it stays within that range, you make a profit depending on how close the maturity price is to the strike price. Now let's summarize our example. The cost of straddle is Rs 200, which is the net premium received. The maximum loss is unlimited below the lower and above the upper break-even point. The maximum profit is Rs 200, which is the cost of straddle. The upper break-even point is 6,200, which is the call strike plus the cost of straddle. The lower break-even point is 5,800, which is the put strike minus the cost of straddle. While you're clear about the reason for structuring a short straddle, which is basically the expectation that the stock or index will remain range bound, remember that it is time to exit the strategy when the market looks like it will become volatile. To quickly recap, a short straddle is a strategy that can be applied to a market index or stock that is expected to remain range bound. It carries unlimited risk but limited possible returns. So, in a nutshell, it is a strategy for traders with a high risk profile. Thank you.